My name is Saima Mahmood, and I work in the Wage and Investment Division at the IRS. And our division's primary focus is on individual taxpayers, so we are very interested in our third session for today, which is on the role of incentives for individual compliance. I'll briefly introduce our very accomplished panelists. Our first speaker is Stacy Orlett, and she is the program manager for the Strategic Analysis and Modeling Group within Headquarters Collection at the IRS. Prior to this, she was a statistician within the Small Business Self-Employed Research Division, and Ms. Orlett is in the final stages of completing her MS in Statistics from the University of Minnesota, Twin Cities. And her topic today will be on the impact of filing reminder outreach on voluntary compliance for taxpayers with a prior filing delinquency. Adam Looney will speak next, and he is a senior fellow in economic studies at Brookings. He's also affiliated with the Urban-Brookings Tax Policy Center. He has served in the Treasury Department as Deputy Assistant Secretary for Tax Analysis, was Policy Director of the Hamilton Project, served with President Obama's Council for Economic Advisors, was an economist at the Federal Reserve Board, and received a PhD in economics from Harvard University. And today, Mr. Looney will discuss charitable contributions of conservation easements. Maggie Jones will follow. She is a senior economist at the Center of Administrative Records, Research, and Applications at the U.S. Census Bureau. She received her PhD in policy analysis from Cornell University, and Ms. Jones will today discuss refund anticipation products and the improper payment of EITC. Our discussant is Janet Holtzblatt, the Unit Chief for Tax Policy Studies in the Tax Analysis Division of the Congressional Budget Office. Ms. Holtzblatt has served as the Deputy Director of the Individual Taxation Division in the Department of the Treasury's Office of Tax Analysis. She was a senior analyst on the Senate Budget Committee and has received her PhD in economics from the University of Washington, Wisconsin. Apologies. Before we begin, I'd like to remind our online viewers that they can email questions to events@urban.org. And with that, I will turn it over to Ms. Orlett to begin.
All right. Okay, hope everybody can hear me. Hi, everyone. Let's see, get this started. All right, so I'm here today to talk about some preemptive correspondence pilots that we conducted. And I want to thank all the authors that were on this. We had a great team working together: Alex Turk, Miriam Musiker, Vicky Karanda, and Rizwan Havid. All right, so the presentation today, I'll go through a lot of background information about how these pilots were constructed, who's in the pilots, and then go into the design of the pilot, what kind of treatments and how everything came together. And then, of course, the results and the conclusions and where we go from here. All right, so this project was a collaboration between Collection and Research Applied Analytics and Statistics, or RAS. So we worked together, and this all came out of actually a study that RAS had done looking at low-income non-filers or potential EITC filers, where they sent them a postcard during the filing season encouraging them to file. So it was a great segue for us to apply it to a different population. Same concept, trying to promote some people to voluntarily file their return. So for our study, we focused on two individual populations, but both of these populations had prior filing delinquencies. And so the first population that we looked at was the automated substitute for return cases. So these are taxpayers that didn't file their return, and we were able to put enforcement action on them, trying to encourage them to file their return. So they were sent a series of notices, and they landed in the ASFR program where more notices were sent, letters were sent encouraging them to file their return. And in particular with this set of cases, or these taxpayers, is the ASFR program was successful in getting them to file their return. So you'll see when we get into the design, what we want with this population is, okay, we have this good behavior where they filed their return, and we want to encourage that same filing behavior to continue. The other population is a group of potential non-filers from a prior tax year. So these are taxpayers that we identified with information we know about them, about their income, that they have a potential filing requirement, but because of resources, we couldn't work them or enforce them like we did in the other population. So what we wanted to do was see, okay, if we can send them a reminder to file their return, maybe we can change that behavior and get them to voluntarily file their return, which allows, prevents us from having to potentially put enforcement action or save those costs if we can get them to voluntarily file up front. So again, the whole point of these correspondence pilots was to promote that voluntary filing compliance. And again, we're looking at these taxpayers that potentially have a higher risk than others because they do have prior filing delinquencies. And as we get into the design, you'll see that we have both a letter we looked at and a couple of versions of a postcard that we sent during the filing season. In particular, we looked at the tax year 2015 filing season. So this is a very simple diagram of identifying and treatment of potential non-filers. And so this is the shaded boxes are where you can see our two populations fit in. So one, we identify potential non-filers, and if they, we have the resources, and based on our ranking, we'll work do enforcement action on a portion of those taxpayers, which you'll see in that first shaded box in the middle, the delinquent return notice process. I shaded this for that second population of potential non-filers. So we identified them, but we didn't have the resources or we did not work them. So the other population is that ASFR cases that I was talking about. So those taxpayers went through the series of the whole process, receiving the notices to file their return, and landed in an enforcement program, specifically the ASFR program. All right, so this slide here is just another overview of our populations, and we had to dive into them a little bit more. So for the first pilot, again, we're looking at ASFR treated cases. So these cases, ASFR was able to send them a letter and successful in getting them to file their return prior to the tax year 2015 filing season. But within this population, there's basically two types of cases that we wanted to divide this population. Those that we have a refund hold versus non-refund hold. So refund hold is this taxpayer recently filed a return and they were due a refund, but they had an unfiled return. So we can hold that refund for a specific amount of time, trying to encourage that taxpayer to file their return. The other is a non-refund hold. So these are taxpayers that landed in the ASFR program and were treated. So it's about 80,000 taxpayers in this population, and just over about a third are refund hold. Now the other population, again, are these potential non-filers from tax year 2013. And we have another division here within this population. So this is we call it a primary code B designation. So basically, you can think about this as lower priority versus higher priority. Lower priority might be those taxpayers that have a lower potential balance due or lower income. And so the reason that we divided the cases that way is because in our process, those what we refer to as PCB are treated in a different way. So one, yes, they're lower priority, but that way it kind of goes in line that if this was ever to be made operational, they have results for both the different divisions of those non-filers. So this population was almost 2 million taxpayers, and only about 16% are the PCB. All right, so this is the design of our project. So again, I'll go through each column here and kind of describe how we set everything up and what we did. So the treatment groups here, we have a control group where no treatment was provided. And then we have a letter. The letter was just a basic one-page letter reminding the taxpayer to file their return. It does have the IRS website on there, and there is a toll-free customer service number. The next treatment was a postcard. We call it postcard 1. And on this postcard, very generic, and you'll get to see a picture of it here coming up, but it does have the IRS website, no phone number though. And the other one, postcard 2, this one has the same information as postcard 1 with some additional information giving the taxpayer information if they wanted to request transcripts or anything else for filing prior returns. So in addition to the treatments, we also looked at the frequency of the treatment. So based on whatever group the taxpayers landed in, they either got one treatment or they received 2 treatments. So we had mailing dates of March 1st and April 1st during the filing season. For the first pilot with ASFR, this one's more simple than the other one where we just have the letter or a postcard 1. And then pilot 2 with the non-filers, we added that we didn't look at the letter, but we did look at both of the postcards. And then we looked at the frequency of the postcard and in that population. All right, so this slide here gives you a little insight or view of what the letter looks like. It's hard to see on the screen, but you can also go to the paper and see it. But basically what you can see is it's telling the taxpayer, please file your return. Here's what you should know. Here's some more information to encourage them to file their return. And then here's the postcard. So I want to keep this in mind as we go through the results. When you look at postcard 1, you can see that there isn't as much text. It's very generic. It's just requesting the taxpayer to file their return. Compared to the postcard 2 on the right-hand side, where again, it's asking the same information as the left, but you have that additional information that we had it on the right-hand side, asking them to, if you need to file your prior returns, here's some information that can help you do that. For example, the 4506T reference where you can file that and request prior transcripts. Technical difficulties. All right, let's go into our data. So what was our outcome? Our outcome we were looking for is, did that taxpayer voluntarily file their return timely, or did they file for an extension? So we have a lot of data here at the IRS to add to our models and into our data set. So we used any information prior to the filing season that we could. So we have income tax information. We have information that was gathered about the non-filers through the case creation process. Any balance due, accounts receivable activity that we have, as well as filing compliance activity. Any treatments that taxpayers received. One other thing that comes with this pilot is because we are sending mailings to the taxpayer, you have the issue with undeliverable treatments. So luckily, the way we had our pilot designed is we were able to identify each of the mailings that came back as undeliverable. So we can identify them in our data set, as well as what treatment that taxpayer received. So because of the issues with the mailing, we wanted to take a two-step modeling approach going through this. So the first step was knowing who had an undeliverable treatment. We want to see what was the likelihood of that treatment being undeliverable. So we took everybody that was treated, and now our dependent variable, was it delivered or was it not delivered? And then that allows us to create an instrumental variable that we can use in the second step. So once we had the step 1, the model from the step 1, we can apply that model to everybody, the untreated and the treated cases, and then go into step 2 and create a model to give us the likelihood that they were going to voluntarily timely file their return. All right, so the next 2 slides here are just going to look at the basic, what percentage of the population or the people in our design and our pilot filed their return. So looking at the ASFR, again, we have that division of refund hold, non-refund hold. So one thing that you can see is that you have a higher percentage of people that are filing their return for refund hold compared to non-refund hold. Again, we're holding that refund and encouraging that taxpayer. And they recently filed, so they probably already set themselves up to continue that good behavior. And then this also, you can see what did we do with those undeliverables in our design. So what we did is we created this untreated group. So we combined the control group with the undeliverables as you go through our results. And then here we have the potential non-filers looking at the filing rates here. The filing rates are similar for both the PCB, which are those lower priority cases, compared to the non-PCB, which maybe are considered higher priority cases. So here again, untreated is going to be a combination of the control group and the undeliverable cases. But let's get into the treatment effects. So this is looking at the results from the modeling. So let's start with pilot 1. These are those ASFR cases. Again, we divided them refund hold, non-refund hold. And what you can see on the screen are the results from the model, but we just showed here the results from each of the treatments, postcard and letter. And as you can look at from both populations, you can see that the effects of the parameters are both positive and significant. And so with the postcard, you see about a 1.3 or maybe 1 percentage point increase. And then the letter was higher. It's almost double for the refund hold. And then for about 3 times higher for the non-refund hold. All right, so let's look at the other population, looking at the potential non-filers. So again, we have the primary code B. These are the lower priority. Here, again, we see from most of the postcard treatments came out positive and significant. The postcard one with only one mailing did not. It was positive though. But you can see that the postcard with only one mailing, you have about a 1% increase in the filing, whereas those with two mailings, you do see a slightly higher impact. So possibly this suggesting that those lower priority cases need a little bit more nudge or a couple more mailings to get them to file their return. Whereas on the non-primary code B, an interesting thing here is, yes, all of the postcards came out positive and significant. But it is interesting to see that the postcard 2 results compared to postcard 1, possibly the fact that the postcard 2, does it have more text? Is it because it's alluding to prior unfiled returns? How did that play out in the results? And one other thing that we are starting to explore is, what did the treatments have on filing prior tax returns? And so when you look at pilot 1 with the ASFR taxpayers, the refund hold, we didn't see a significant impact on filing those prior returns. But again, because of the design, those taxpayers likely have already recently filed returns. Compared to the non-refund hold, we did see the postcard have a positive impact or significant impact there. And then more so for pilot 2, you see a positive and significant impact on filing prior returns as well as the current returns. So conclusions, looking at each of the treatments, the letters and the postcard, we saw positive and positive impacts on filing. They may be small, but also keep in mind the size of these populations. So even a 1, 2, or 3% increase can be a lot of taxpayers or a lot of voluntarily filed returns with minimal cost. Also looking at the type of treatment. So looking at ASFR, that's where we had the letter and the postcard, but we saw the letter was either 2 or 3 times higher. So that's one thing to explore again, is maybe we want to see what was the difference there. And then again, when you looked at the postcard and you saw the 2 different types of postcards, and you think about the taxpayer receiving them, how would you feel looking at a postcard that has a lot of text versus a simpler text? Maybe there's something there, as well as the frequency of the treatment that we saw. And so those are some of the things that we can look into for directions for further research with that.
Okay, thank you very much. So I'm here to talk about charitable contributions of conservation easements. So this is a tax deduction intended to encourage conservation of environmentally important land and historical buildings, and to talk a bit about how it's used. This work was prepared while I was a Treasury employee, and so any opinions or interpretations are my own. So first of all, I just wanted to start off by talking about what is a conservation easement. So it's a legal agreement, a voluntary legal agreement that limits the development or use of a property. So for example, if you owned a lot of acres of environmentally important forest, you could write a legal agreement that permanently limits the ability to develop that land, allowing it to remain forever as a forest. And then you can donate those rights to a land trust or a charity or a government, who will then own and enforce those development rights to make sure that the forest is preserved forever. Donations of qualified easements can qualify to be claimed as a charitable deduction against income taxes. In order to qualify, the donation must be to a qualified charitable organization, which is generally a 501c3 or a government entity, and it has to be for a qualified conservation purpose. So that means preservation of land for recreation or education, protection of natural habitat, and for preservation of open space subject to certain rules, like that it further a certain conservation purpose. So the valuation of the deduction is generally determined by a hypothetical comparison between what the value of the land is with the easement in place and what the land would be worth under a hypothetical highest and best use. And it's proved to be a very popular provision. So it's widely lauded by the environmental community. and politically popular as well. So in 2015, the benefits for contributions of donations of easements were permanently enhanced. And that means that in certain cases, as for farmers and ranchers, the benefit of donating an easement can exceed the benefit of just giving straight up cash. The provision has also proved difficult to administer and enforce. So, for example, it's been a recurrent item historically on the IRS list of dirty dozen tax scams. According to the National Taxpayer Advocate, it's among the most litigated tax items. Last fall, the IRS included it among listed transactions that require additional disclosure from taxpayers in certain cases. And this is all fairly surprising to me, given that I had never heard of it until I started working at Treasury, and that only about 2,000 taxpayers a year actually claim a donation for a conservation easement. And so it's very hard to know what's actually going on in this space because there's very little data or evidence on the use of conservation easements in the public domain. And my experience is that this absence of evidence allows interested parties to suggest that anecdotes or the examples of litigation are aberrant or the product of a few bad apples rather than something intrinsically wrong with the deduction. And so it's certainly not the largest or most important tax expenditure out there, but it is large and growing, and the use and the potential abuse of the deduction has been increasing in recent years. So in 2014, it appears to have roughly tripled relative to the level that had prevailed for the prior several years. And these are relatively complex provisions. They operate opaquely, which gives the impression that sophisticated taxpayers that take advantage of them are getting a better deal or somehow gaming the system. The tax benefit, almost by construction, accrues almost entirely to high-income, high-wealth taxpayers. And so it's got this element of being the confluence of many important tax themes: complexity, difficulties in compliance, efficiency, fairness, distributional issues, revenue. So it's a kind of microcosm of a lot of different issues. And so what I'm going to do in this paper is just ask how they're used and give you a description of what the data say. I'm drawing primarily on data and evidence that were amassed in the development of budget proposals and policy analysis. These are drawn from samples of returns used to inform Treasury's models. And then I will supplement this with public filings from donee organizations, basically Form 990, which is data is publicly available on, for example, the IRS SOI website, and also the actual PDF returns available from GuideStar. So to summarize the evidence, first you see that donations are very concentrated in transactions, in land area, in geographic areas, and in donee organizations in ways that often seem unrelated to conservation benefit. A small number of organizations appear to be responsible for a very large share of all donations, but those organizations are not necessarily large stewards of land or important conservation organizations in the grand scheme of things. And many important donee organizations, those that receive a lot of easements, don't appear to report them as gifts, which makes it very difficult to identify those organizations in public filings. And it also may allow them to avoid certain legal rules that differentiate public charities from, for example, private foundations. I'm primarily going to look at information from the 2010 to 2012 filing years. Just to summarize these data, there are about 2,500 donations per year, about 2,000 taxpayers per year. Donations are highly skewed by value. So, for example, the median donation is about $100,000. The average donation is about $430,000. And about 5% of these transactions exceed $1.3 million. I'll also talk a little bit about the acreage. So about a third of the transactions report acreage and the median deduction, the value of the donated easement prohibiting development rights is valued at about $1,600 at the median, and about $15,000 on average. So again, very skewed towards certain transactions that have very high costs in terms of a cost per acre sense. And so the first observation I want to make is that the concentration of donations is highly concentrated in a small number of donations and in relatively expensive acreage. So what this table shows is that the top 2% of transactions account for about 43% of the total aggregate value of donations claimed by taxpayers over this 3-year period. And the top 10% account for about 70%. And then the second two columns there look at acreage. So for properties that include acreage, the top 2% or 2% of the acres placed in easement accrues about 26% of the tax benefit, and the top 10% about 70%. And just to achieve those kinds of concentrations, that means that the valuations of easements in the top of this range must exceed $10,000 or so per acre, and sometimes rise over $100,000 per acre. So they're kind of very large dollar transactions and very large relative to, for example, the characteristics that we can observe of the land. A second pattern is that it's highly geographically concentrated in ways that also seem unrelated to conservation effort. So the most striking thing is just that 36% of the nation's deductions of conservation easement donations were taken by taxpayers in Georgia over this 3-year period. And the second largest beneficiaries by state of residence are California and Connecticut. And so what you can see from the table is that the number of land trusts, the number of acres under easement, and the total number of acres conserved by all means is basically unrelated to the conservation amount. So, in particular, Georgia, even though it claims 36% of the total value of the deductions, it is not otherwise a leader in the number of land trusts, acres under easement, total acres conserved, or even in terms of the charitable giving more generally. And another striking thing I want to point out is that there are a lot of states that are national leaders in the number of acres under easement and in conservation. And they receive only a de minimis share of the tax expenditure. So on this list, you can see that Colorado gets about 2% of the nation's benefit, is responsible for about 13% of acres under easement. And then there are many key states, Maine, Montana, New Mexico, New Hampshire, Wyoming, Arizona, Washington, that are not even on the list, each getting less than like 0.5% of the national total. And so, I don't know if you can read this chart. I will summarize. So switching to data from the 990, the public forms, what we did was we combed through these public filings to figure out how many dollars of easements were being contributed to different organizations. The largest land trust over a 3-year period that we examined was an organization called the Foothills Land Conservancy. It did almost $250 million it received $250 million of donations of easements in 1 year. I think the next year it was ranked by Forbes as the 67th largest charitable organization in the country. It has 4 employees. The second largest on this list is the Nature Conservancy. Obviously, Nature Conservancy, worldwide organization, several thousand employees, manages several million acres of land. A vastly different organization. And so three things to take away from this table. So one is that the top 10 organizations report about $350 million of donations per year on average. That's about a third of all donations in those years. Second, there's a lot of variation between the total value of easement donations received, which is proportionate to the tax expenditure, the tax benefit, and to the size and conservation effort provided by the entities. So there are some organizations that are receiving a large amount of benefit, but that don't have very large operations, for example. And a third observation is the data quality is not super high in the 990. We had to dig through the PDF forms to actually find the data on easements, which are often in footnotes. And then it turned out not to be comprehensive. So what I mean by that is that when we compared the information on the 990 to the information from the returns of individuals, the Form 8283, which lists the contributions that individuals make and the donee organization to which they had made those contributions, there were many organizations that seemed very large that did not appear in the 990 data. Some of these are government agencies that don't file 990s, but many of them were 501c3s. So what this table does is it kind of replicates the table that I just showed you. It shows you in aggregated bins the top 5, the next 5, etc. Organizations and their characteristics. So what you can see, for example, is that the top 5 organizations received about a third of the of deductions, but only 2 of the 5 reported receiving those gifts on their Form 990. And indeed, of the top 25 organizations, 4 are government agencies, which don't report, obviously. But the other of the 21 public charities that received the most gifts of donations of easements, 15 do not report those gifts at all on their 990. So it's a problem because the organizations that receive these contributions avoid public oversight, and it also might allow organizations to sidestep some important legal tests, as I mentioned. So what's going on? So in brief, there's 2 things. So the large donations in this concentration have 2 characteristics. So first, it appears that many of these donations are associated with real estate development. So for example, a recreational community surrounding a golf course or a tennis club, or a suburban residential development. We found that the average deduction claim for a golf course was about $19 million. So a single transaction can be 5 or 7% of the total. A second factor is that many high-value donations appear to occur in high-cost areas of the country, so suburbs or resort communities. And so I think this illustrates a fundamental problem with the structure of the donation. You have this incentive wherein the value of the donation increases with the location of the property and with the improvements that have been made to the land. So because a property with roads, utilities, golf courses, it tends to be worth more than undeveloped land. Developing the land increases your donation. And as just one illustration of this was a random photo pulled from a website that maps easements. I don't actually know what it is, but what you can see is that the blue is the easement, the remainder is the development property, and so someone has built a bunch of homes and then put the remaining area into an easement. And I think that really boosts the value of the donation. The paper goes through a list of options of how to address these, and so I won't go through them now, but just will say that a lot of them are aimed at increasing transparency, such as reporting on 990s, but also strengthening the legal rules that apply to what qualifies as an organization and what qualifies as a donation. I'll stop there. Thank you very much.
Hi, I'm very glad to be here today. I'm going to be talking about tax preparers' refund anticipation products and EITC noncompliance. I would like to point out the disclaimer. It's the usual disclaimer from the Census Bureau, which says that these opinions are my own and not the Census Bureau's. There's also a little extra on there talking about the contract under which I perform this research, which is basically, I'm contracted by the EITC office to do their take-up rates every year, and this is an added project to that. So, to give a little bit of an overview of what I'm going to talk about today, tax preparers offer a couple of different products to customers that speed up the refund time or pay the tax prep fee after the refund is worked out. These products are targeted to low-income taxpayers who are often poor credit risks and unbanked, and they meet many of the eligibility requirements for the larger credits in the tax system, such as the EITC and the child tax credit. And what we should be concerned with is that tax refunds, mainly the EITC, constitute a large portion of the U.S. safety net these days, and there is a substantial incorrect payment rate. And some of the safety net monies, including the part of it that is potentially incorrectly paid, go to the preparers rather than to the recipients in need. And so this creates a policy question that we should probably look into. And if the EITC or any other type of credit is incorrectly paid, the burden and the repercussions of the audit often fall on the taxpayer as opposed to the preparer. So these are all questions that I'm going to be looking into in this paper. What are these things? There are two different types of refund anticipation products that I'm going to talk about. There's some others that are kind of less used, but the two main ones are refund anticipation loans and refund anticipation checks. The first one is a loan of the full refund, and the refund secures the loan. So this makes the product very profitable to tax preparers. The taxpayer pays substantial fees and usually a 3-digit APR interest rate on a loan such as this. And the preparer arranges the loan, but the loan is made through a consumer finance company that contracts with the preparer. These first became available in the 1980s, and they grew out of the increase in e-filing. And between 2000 and 2010, the IRS provided what was called the debt indicator, which made the product very profitable because the IRS would tell the preparer whether or not a taxpayer had a lien against their refund. When the IRS announced in August of 2010 that they were eliminating the debt indicator and they weren't going to tell preparers anymore whether or not somebody had a lien, it led to a massive withdrawal of the product offering beginning in the next tax season. And all of the major players were withdrawn by 2012. These are the rate of refund anticipation loan use by the taxpayer in zip code bins. So for every zip code, the denominator is the number of taxpayers and the numerator is the number of people receiving a refund anticipation loan. As you can see, in 2008, the use of this product was very widespread and associated with different geographic areas of the United States. And then in 2014, everybody was gone. So the gray is there's no information, essentially. And the red that you see in 2008, that's a rate of about 25% for those areas. The next product is a refund anticipation check. These were in existence at the same time as refund anticipation loans. This is where a preparer sets up a temporary checking account into which a person's refund is deposited. And the main purpose and why people use these is it pays the tax preparation fee up front, and then that's taken away from the refund when the refund is paid to the taxpayer. And that's in the form, usually these days, of a prepaid debit card. And so the product is essentially a lending of the tax prep fee. And again, the APR is often greater than 100% on what turns out to be a very short-term loan. These were originally much cheaper than refund anticipation loans from what information I'm able to gather. Recently, the price has increased since the debt indicator was eliminated. And much of that increase in price has been on add-on fees and check cashing fees and fees associated with the debit card. Also, higher cost refund anticipation checks, which is something that I'm going to be exploiting later, are associated with higher refunds. So they're more lucrative, or you can ask a taxpayer to pay more for them if the taxpayer gets an EITC with a child's claim. Oh, and the other important thing you need to know is that taxpayers can buy these online, whereas refund anticipation loans were not available online for the most part. There were some offerings online for refund anticipation loans, but I've gone back in time on the Wayback Machine online, and they look really sketchy. I would never actually use any of the tax preparers who are offering them. Okay, so here's refund anticipation checks done in the same manner, and you see the really large increase in use between 2008 and 2014. My motivation and research questions are, we know that taxpayers have perverse incentives to claim the EITC. The credit is very generous, and we know that the price tag of incorrect payment is in the tens of billions of dollars every year. We also know that between 22 and 25% of EITC receivers are paid erroneously. And so knowing these things, we also know that tax preparers have a perverse incentive to make erroneous EITC filings on behalf of their clients. EITC filings requires further worksheets and a higher preparation cost just to start with. And then the higher the refund, the more lucrative the loan you might make if you're making a refund anticipation loan. And the higher priced checks are associated with more lucrative refunds. So the question is overpayment of EITC associated with paid preparer filings and refund anticipation products? And I'm going to show you that the answer is yes. There's no doubt about it. The next question is, can we really separate out these two different perverse incentives in terms of the preparer and the taxpayer and find that incorrect payment of EITC has a causal relationship with paid preparer use? And I get mixed information on that question. To go into a little bit more detail on the perverse incentives that a person might have, filers buying a product are going to be interested in basically consumption smoothing. So they want immediate cash to pay off more pressing bills. They lack access to any other types of forms of credit. And they believe that going to a preparer might help them avoid an audit. So we have this group of people who might be selecting into improper payment because it makes them better off, perhaps in the short term, in a sense. Preparers have perverse incentives in terms of they're encouraged to sell these products because their bonus systems are related to how many they sell, and it's related to their job performance. And we know that preparers don't have a lot of breaks on filing improperly. So they're not licensed in any particular way, as we've talked about earlier in the day, and they often don't face repercussions for erroneous filings, and that burden is going to fall on the taxpayer. One of the issues on these perverse incentives that I don't have is there's no price data on the products. We can rely a little bit on mystery shoppers that have gone out and tried to get a sense of how expensive these products are. First of all, the final price on a product and tax prep combination is often much higher than is originally quoted when somebody first walks through the door. And the highest refund anticipation check and prep total price was about $330 to $540, which represents 20% of the average household EITC. So these are expensive compared with the refund that people are going to receive. So a lowball estimate of the total amount of money that is going basically from the tax and transfer system to preparers is about $848 million in 2014. Now, to get to the data, I have a variety of IRS data that's used for the EITC take-up rate. Form 1040 individual income tax files, Form W-2, and the EITC recipient file. Each of these files comes with an SSN, so when we apply a unique identifier at census, it's basically a one-to-one match, and I match about 99.6% of the people in these files. I also received from the EITC office a record of tax filers who purchased a RAL or RAC. The combined data allow for identifying preparer filings, online filings, and paper filings. And then in categories, preparer filings and online filings allow for product use. So I can look at RACs and RALs separately. And in some sense, I'm going to combine them because the refund anticipation loans disappear over time. The next data set I use is the CPS ASEC, and we place the identifier using probabilistic matching, get a match rate of about 90% each year, and then the tax records and the survey files are linked together. I then have what I like to refer to as Franken data, and so I'm going to use the CPS ASEC person weights and use inverse probability weighting to reweight those. And what I'm trying to get back essentially is the population, or something that represents the population of tax filers in each year. Okay, this graph shows the product use by type of product for 2008 to 2014. What I'd like to point out is if you look at the dashed line, that's the preparer refund anticipation loan. And then the black non-dashed line is the preparer refund anticipation check. And as you can see, when the debt indicator was removed, there was a dramatic drop in 2010 in the preparer refund anticipation loan. And all of those customers appear to have been moved into the refund anticipation check category. There's a very small number of people who received an online RAL, like I said, truly sketchy kind of thing. And then online refund anticipation checks, you can see just increase gradually over the time period. And this next graph shows incorrect payment rate by filing type. The black line shows well, let me start from the bottom up. So the lowest improper payment rate you see is in the paper filing category. For online and preparer filings that do not have a product, the improper payment rate looks pretty much the same and is around the average overall for everyone, which is about 5% for all taxpayers. And then the incorrect payment rate for online and a product added jumps up to between 7% and 1%, and then the incorrect payment rate goes up to about 1.5. I'm saying these wrong. So about 1%, and then about 1.5, 15% for incorrect payment by filing type when you have a preparer and a product combination. And so the next slide is going to show some econometric modeling, and all it's doing is basically in a model form calculating the differences between these different lines. And what I'm interested in is the elimination of the debt indicator in 2010 and comparing the peak that you see in the black line, which is preparer plus product, compared with the solid blue line, which is online and product combination. That's basically what's reflected in all of the math that you see there. I'm going to use paper filers as another base group to what is essentially a triple difference. And I'm going to be comparing this group with online filers and those using a preparer to give a picture of the incorrect payment rate induced by preparers and product use together. And then, like I said, the triple interaction with the year 2010 estimates the impact of the debt indicator removal. The mechanism I'm attempting to capture is that preparers were forced to sell refund anticipation checks versus loans, and they historically sold higher priced refund anticipation checks based on higher refunds which were associated with the ITC. Oh dear. Okay, I'm going to just cut to the chase. Preparers and online both have higher rates. When you add a product, that increases, and for preparer times product, it increases by a lot, 7.8% percentage points. And then when I look at a preparer times product times 2010, I find an increase. It is not statistically different from the online triple interaction in 2010, but it is the only, it is the only coefficient from that econometric model that is statistically significant. The others are all not. It's the only bump up that you see there for 2010, and that's it. I won't conclude because I just said it all.
button. It was green, so I thought that was sufficient. My thanks to the conference organizers, especially Alan, for inviting me to discuss these papers, and my thanks also to the authors for making this a task, an opportunity to learn more, and I did learn more. And as a reminder to everyone, these views expressed in the comments are mine and should not be interpreted as CBO's. As the title of this session informs us, the common theme of these three papers is the role of incentives in individual compliance. Do gentle nudges spur people to file tax returns? Does the combination of big benefits and little transparency spur tax evasion or maybe avoidance? And if so, who benefits? And third, do third parties, and in this case, tax preparers, inflate their clients' refunds in order to take a larger share for themselves? My goal today is to consider how the author's findings about incentives go to the broader theme of today's conference. How do their findings inform IRS's organizational choices, particularly if the goal is to achieve a high return on investment subject to resource and other constraints? I will comment on the papers in the order they presented, starting with Stacy's. Stacy really does motivate this paper explicitly without administrative challenge. Resources are declining, deficiency procedures, one of the normal ways of dealing with non-filers, is labor intensive and expensive, and such the IRS prioritizes and deals with some people with lower enforcement procedures and others none at all. So the decline in those resources motivates this research into looking at the benefits of preemptive outreach as a way to see whether there's a less expensive, less labor-intensive way to bring non-filers into the tax system. In doing so, they build on a growing literature that tests the effectiveness of nudges. Much of that literature focuses on messaging, whether appeals to social norms, civic duty, personal benefits, or fears prompt people to behave in the desired manner. This literature is also useful in one's personal life. It worked for me on the condo board to get 100% participation in our recent program to replace batteries on their smoke detectors. So I'm very thankful, and I hope the IRS can benefit as well. Now, the focus of this study is less on messaging per se than on the form and frequency of the outreach. Most of their research yields answers that are not surprising. Correspondence increases filing, provision of more information about how to file further increases filing, frequency of correspondence helps, especially for the low-risk people. The answer to one of their questions may have been surprising, perhaps, to some in the IRS. That question was, does the form of the correspondence, a letter or a postcard, affect participation or affect the results? Now, I chuckled when I read that question because even 20 years ago, I often heard the anecdote, which is repeated in the paper, that there are people who, when they receive a letter from the IRS, don't open it. In fact, it was always colored by really delightful descriptions, like people who would get the letter and put it on top of the refrigerator, which for people like me is really a deterrence to ever looking at that letter. It also resonated with me because I don't ignore letters from the IRS. I hope none of you do. But there are other things. There's a Christmas card, for example, that's been sitting on my table for 6 months that I refuse to open. So this is human behavior of some sort. But while I recognize the anecdote and the resonance of it, I'm not surprised by the finding that the response was higher for the letter. Ultimately, even the form of the correspondence is about messaging. And I will point those of you who haven't seen this to a paper by Ben Maselman, who's a recent University of Michigan PhD, and he focused on a similar topic. He looked at ghost taxpayers, these was his terms for non-filers, who did not file a city tax return in Detroit. And he looked at the effectiveness of different types of messages. What he found was the threat letter, the letter that included information already known to Detroit about the tax status of the taxpayer was much more effective in spurring filing than those that spoke to social norms, civic duty, or personal benefits. I mean, it's likely that the letter, even one that you don't open, is going to be more of a semblance to a threat than a postcard, like the ones you get from the post office around Christmas time. I throw them out. So although there was some examination of the content of the message, I would have liked more, and seeing, these different levels of messaging, how they were effective. Now, what more would I've liked from this study, which I liked very much? Can we figure out a way to get people to file if we don't understand why they don't file? I always wonder about, and this came from my experience as a volunteer preparer, the refund offset excuse. People who didn't want to file because they knew they owed something to another government agency or for child support, and anything they would have gone back from the IRS that year would have gone to pay for prior debt. Other languages barriers. I believe the correspondence was solely in English. Would that have made an effect if there had been other languages? And who are the undeliverables? The other thing that's missing in terms of the analysis is the benefit-cost ratio. And there's two aspects of that. One is how much money was recaptured from the IRS as a result of filing. Were the people who responded those who had a smaller tax payment? And then what was the cost? I mean, obviously, I think a letter or a postcard would be a lot cheaper than an efficiency procedure, but you're sending it to more people. And there's one of my favorite, or two of my favorite IRS employees would always tell me when I was chair at Treasury, it's the phone calls, it's the follow-up. How much is that in imposition on the IRS? Adam's paper read like a John Grisham novel. And that might have been because I was reading a John Grisham novel at the same time about shady developers responding to another government thing. And there were a lot of golf courses involved. Now, I was glad to hear you knew little about this before you went to Treasury, because I knew shockingly little about conservation easements. So thank you, Adam, for educating me. Now, I sensed reading the paper that you were largely motivated by the policy question. Is the conservation easement achieving the intended policy goal? But you also raised, and you raised it here, the important administrative question, pointing out that these easements are among the top litigated cases for the IRS. In looking at this, Adam weaves together, he's masterful at this, data from a variety of sources to paint a picture of the use and users of conservation easements. And this picture is compelling in its revelation of the surge in deductions. I told you it's like a John Grisham novel, as well as the concentration of easements received by a small number of organizations. Some of those organizations quite small themselves, even though the reported value of their easements is quite large. Now, the picture is incomplete for several reasons, which Adam goes into some detail in the paper, if not here. And let me say at the onset, this is not him. This is about the data that's available. On the forms that donors attach to their tax returns, 82, 83, they don't always provide descriptions of the donated property, and sometimes they don't always report in a legible form the name of the recipient organization. Some governments, as he pointed out, some organizations, governments in particular, are not required to file Form 99, the donor form, and the amount of information required to be included on that form varies with the size of the organization. And the organization, I found this very interesting, are allowed to use financial accounting standards to determine the value of the easement, which sometimes means that they only report $0 or $1 or a trivial amount, because that's what's allowed in the financial accounting standards. So sadly, as a result of those limitations, not only does the IRS lack sufficient information, but some of these organizations are excluded from your Adam sample, and those that are excluded may not provide sufficient information for analysis and evaluation. Adam supplements the data from the tax returns with information from a sample of audits, mainly about golf courses, as well as anecdotal evidence about the marketing and nature of easement transactions. One thing that those anecdotes highlight for me was the broad network of middlemen engaged in marketing and who really don't have reasons to interact with the IRS as much. And we all know a problem, though, with audit data and anecdotes is the selection process. That with the former case being those that catch the attention of the IRS, and the latter case those that catch the attention of the media. As a result, the worst cases, or detectable worst cases, become the norm. So we got all these great findings from the tax returns, the audit data, the anecdotes, enough to raise our eyebrows. But do we know from this information sufficiently the extent to which these developments are based on good intentions, or maybe legal avoidance schemes, or of their evasions? And that distinction matters with respect to the IRS's use of limited resources. A third of Adam's paper, which is unfortunately he didn't get into much here today, so I will do it for him, is that nearly all of his, is a third of it's devoted to options. And nearly all of those options, or most of the pages, relate to enhancements of reporting requirements by donors and primarily recipients. Such reporting requirements would, I think, achieve one of Adam's goals, which is to increase transparency, improve consistency in reporting across organizations, and facilitate the evaluation of conservation easements. How would that information affect enforcement? Would simply provision of more information increase voluntary compliance? We know that information reporting helps, but does it help when there's not third-party information reporting? This would be information reported by the donors and by the donees, but could you match that information? And I think it would be difficult without having some system of unique identifiers. And also the amount of information that's required, such as descriptions of property and so forth, are not the kinds of information that are easily automated. From my perspective, this information would be very helpful. Ooh, put that away. That information would be very helpful in terms of reducing the cost of litigation up front, but I don't think it eliminates the need of litigation. Quickly, Maggie's paper. She has identified that the incentives to overstate the EITC are not limited to the recipient, but also to third parties or other parties, and in this case, the focus is on the preparer. Now, there's not necessarily something bad about preparers recapturing a portion of the EITC. Think of it as privatization of some of the administrative costs for the IRS. It is an issue if they're claiming more than what covers their costs. Her findings, as she points out at the end, are not necessarily somewhat ambiguous. We find that there's an association with preparation and these refund anticipation products, but at the same time, there's no significant difference between whether it's coming through the preparer or online, or your online preparation. So what else is going on? That's an item for more research. What else would I have wanted? I get concerned with using the CPS as a way of identifying or measuring improper payments. There are survey errors in the CPS, there's imputations in the CPS. I'm not sure from the paper how much complete information was received from the IRS. Certainly if there wasn't, that could also introduce some errors. My question is, could the study be replicated using information from the NRP, which is now available for the same time period as she was studying in her paper? Another thing that I thought would have been useful for the analysis, and maybe that's because of what IRS didn't provide, is the inclusion of an indicator of distinctions between types of preparers. We found back in the 1999 EITC compliance there was a much lower error rate for returns prepared by an attorney, a CPA, and a road agent, or a nationally renowned recognized tax preparation service, rather than those prepared for any other type of paid preparers. So that's another factor in all of this. I'd also would like to have seen analysis based on the size of the EITC error, the amount of the error, rather than the presence of an error on the tax return. And I will skip the rest of my material and not have to see the young lady put up that stop sign. Thank you.
Okay, before opening up the floor to questions, I'd like to give the authors an opportunity to respond to the discussion.
Thank you for those comments. The letter and the postcard was very interesting. If we could go back in time, we want to do the letter with the other population. So I think that exploring that letter versus postcard, I mean, the thing is with the ASFR, you have these taxpayers coming out of a series of a period of time where they're receiving multiple letters. So is it because they received another letter thinking, wait, I just corrected my behavior, I'm okay? How would the other population have reacted too? So yeah, and other great comments. Thank you.
So, yes, I think there are concerns with using the CPS. We have done our best to benchmark the results against other available audit information. Each year we seem to be in line with the estimate. Of course, that doesn't mean that the same people are being identified or the same type of people, but the overall rates are very similar. But yes, I would love to use the NRP to look more closely at that.
Could you get her the NRP?
Is John Gordon here? I've asked him for it before, but
Hey, could I get it too?
So yes, the definitely using the size of the AITC is a work in progress. So that's another step that I'm going to
So
take.
let me interject with a follow-up question, which is, how extensive was the information you got from the tax returns?
The tax returns are the delivery of the tax returns are designed for the EITC project, essentially. So all of the variables that I receive go into EITC estimation. Yeah. So. Yes, and I'm also supposed to get the identifier for the preparer. So
Okay, good.
eventually.
Okay. For our online viewers, a reminder that if you have any questions, please send them to events@urban.org. And I'll open up with a couple of questions. So my first is about the impact of the filing reminder outreach. And you stated that referring to past potential noncompliance in a postcard might make the taxpayer a little more hesitant to file. So I'm curious about how we could go about quantifying this behavioral response as well as a failure to open barrier.
That's a good question. I don't have an immediate answer, but that's something that we've been talking about, because even coming out of RAS's study last year when they looked at behaviors of taxpayers and why they didn't file, it's one of those, it's just an interesting question that if you put it on the postcard alluding to the fact that we're not telling them that we know they have prior filing delinquencies, but if we bring up that reminder, are we kind of shutting them down from wanting to respond and file their return voluntarily? So it's a good question. Good question.
And my second question was about the conservation easements. You stated that it's among the top 10 most litigated issues between the IRS and taxpayers. What is the general disposition of those cases? Does a tax court usually side with the IRS or with taxpayers when valuing the assessment?
So the litigation is often about valuation issues. So about how much the donation should be worth, and so often it's not sometimes it's an all or nothing difference, but sometimes it's a split. My recollection from the cases is that the IRS wins more often than not, and then sometimes splits, but that the reasons are often varied. So it might boil down to technicalities about whether the taxpayer is essentially at a foot fault when they entered the agreement versus a real decision about whether the easement fulfilled a conservation purpose or that it was valued appropriately.
Okay, thank you. Okay, I'll open up the floor to questions now. Right up here.
I just wanted to make a comment and I guess sort of a question, dovetailing on what you just said about the content of the postcards and referring to previous previous monies owed, because one thing that I think is very difficult in doing this research is sort of teasing out what would be driving the behaviors, because on the one hand, it could be the, I might be in trouble because they're referring to something, referring to previous years. But one thing is that you also have differences in the size of the text, and so with something like a postcard, I know that there's been lots of research on kind of the colors and the fonts and all of that kind of stuff, and I was wondering how you manage to take all of those things into account, or how do you even narrow down the set of questions you can address in any given study? I suppose with things like font and color, you could be bringing in some outside research on length of text and how people process information, but I guess that this is sort of the, what do you think?
No, that's a really good point and a really good question. And I think that's something that obviously we discussed when we were designing the pilot too, and adopting from other pilots people have done in postcards, but now it just brings up more questions like, well, why? Is it too much text on there? Because that is one thing for me. If there's a lot of text, I'm like, oh, I don't really want to read that. So it's a good question.
They've also done research on color of paper or color of envelopes in some studies and notices.
Right. That's also, and I don't recall, so I'd have to ask my team if there was like limitations to what we could use at the IRS for that too. So that also plays into it. So good question.
We have one up front, right here.
Thanks. This is a question for Adam. I was struck by the aerial photograph of the development. And so I was wondering, what is the taxpayer getting when they make a conservation easement? What are they getting that they wouldn't get if they had just simply donated the entire amount of the land?
So if they donated the land, they would. I mean, I think they certainly could donate the land. I think that there is and if they donated the land, there are valuation issues there. They'd have to have an idea of what the value of the property was. They get an appraiser from similar sales. I think that the advantage of not giving the land means that you get to preserve it as in its current use. So, for example, there's a big difference between giving a golf course to the Nature Conservancy and having them be able to bulldoze it and plant a forest there, than you being able to maintain the golf course as a golf course in perpetuity, as open space for the birds to land on and whatnot. And so that's, I think, the key. It's also, you can exclude people from the property. So you can put it on your personal property. You could have an easement on your personal property, and you could still have a fence there so that nobody could walk on it. But if you donated the property outright, harder to do.
We have one up here.
I have questions for Stacy and for Adam. I'll just tee them all up at the same time. In terms of your postcard 1 versus postcard 2 design, I was wondering what was the thought behind leaving out the phone number in the second one. Was there any psychology that was driving those factors? That's the first question. The second question was, is there any concerns around privacy violations to a taxpayer if you even allude to the fact that there may be non-filings earlier on a postcard as opposed to a letter? The third question is, you said the impact was small. Would that be more positive? I thought that was actually pretty good, your results were. Would you be able to make a stronger statement if you actually calculate what you would have spent in enforcement actions on those same folks based on the characteristics of those type of taxpayers, and you could say that I saved X dollars? Those were my 3 questions for you. And the question for Adam was, it was fascinating again to see that. What is a couple of questions there I had was, you said it was listed on the dirty dozen schemes. If that is the reason, and if there's already enough recognition for that, could we use that as a deterrent and create more visibility for these conservation easement efforts to reduce bad behavior? Did you look at whether these returns were filed by specific preparers? Was there a relationship between the donor and the donee organizations in these cases?
All right, so if I forget any, let me know. But I'll start with the phone number. One of the hardest things right now at the service is trying to answer phone calls. And that's one of the drivers for possibly reduction in enforcement actions. Is one of the repercussions of enforcing someone is you do have them calling in. And so by the postcard gave us the opportunity to give them some sort of correspondence without that phone number, in hopes of, okay, hopefully we get them to voluntarily file without the incoming phone calls and that burden. So that was one of the main things. When you do a letter, though, there is a requirement to put some sort of phone number. So we were able to just do that general tax form number. But there is data that was suggested to me, that we're going to look into it just to see what kind of response did we still have from the postcard and from the letter, who called and things like that, because we definitely want to capture that information. And in terms of disclosure, we worked really hard on the design of the postcard so that it wasn't leading to the fact that we know that you have prior filing delinquencies, but more of the informative, hey, by the way, if you can still file your prior returns. And a great comment on the cost, because you can definitely say, if we had treated them in the normal chain, this is what it would have costed. So by giving them that, reminding them or nudging them to voluntarily file, it saved the service that potential cost down the road. So good comment. Thank you.
So first, the question about what do we know about the people who are engaged in this? So I think that first of all, they're all fairly sophisticated taxpayers, in that you have to be pretty high income, you have to be able to structure the transaction, you have to have property, and so I think that all of them involve a substantial amount of legal help and preparation. Establishing the easement is itself complicated. You have to have a legal agreement drawn up with the donee organization. So I think that there's kind of two patterns that you see among the cases that look like they're potentially abusive cases. So one is these cases of syndications where someone has clearly structured a deal in order to harvest the tax donation and to use that to help finance the investment, or at least to offer that as a return to investors. So in those transactions, those are transactions where basically somebody will establish a partnership, they'll buy the land, they'll sell out partnership shares to investors. The return to the investors will be in part any stream of income from the development, but will also be a return of in the form of a share of the donation of the easement. And so those are pretty obvious cases where there's potential for abuse. And you see that there are some areas that specialize, some places that specialize in that. There's another pattern, though, which is almost identical to that, except that they don't sell off the donations. And so those are cases where there's just a large taxpayer or a large developer that can use all of the donations themselves, and they have no need to syndicate and sell off the shares because they can use the whole tax break themselves. And so in those cases, they're not, part of a systematic or organized by a certain group. They're idiosyncratic and they occur everywhere as almost like one-offs. And then on the dirty dozen issue, I think that this has proved to be something that's been hard to enforce for very many years, and then there have been problems for many years at the federal level. But then a lot of state systems have had credits for conservation easements, and they've had very much the same sort of problems. Colorado had to reform its system. Georgia just reformed its system. And other places have preemptively changed their systems and imposed rules that attempt to differentiate kind of the good from the bad actors. And so I think that's the intent of the Dirty Dozen list, is to provide some guidance to watch out for who are the good and bad actors, although I think that it is not a sufficient admonition to stop the people who want to engage in the abusive transactions from doing that.
Any more questions? We have one in the fourth row over here.
Hi. So, you know, the earned income credit, you know, there's two, you know, compliance issues, right? There's folks who claim the credit that aren't eligible for it, and that's sort of what your paper focuses on, and it looks at the impact of products and preparers on that, you know, loan products. The other side, of course, is that there's folks who, you know, don't claim the credit that are eligible for it. And we know the take-up is pretty good right now, but, you know, part of that might be because of preparers and products, that there's an added incentive to encourage people and to find those credits that when they are eligible. And it'd be nice to sort of see both pieces of that to sort of understand, you know, the full picture. The other thing is that, you know, what the paper highlights is that, you know, a lot of the people who are entitled to refundable credits, you know, do have problems with getting cash. And, you know, one wonders if there's ways to help with that, you know, beyond just have preparers who offer kind of lousy deals. And, you know, one thing that's been done in the past that hasn't worked too well is, you know, advanced earned income credits, right? You know, but maybe the IRS gives people a debit card rather than a check, and maybe they can use that. You know, things of that sort might be helpful.
I taking your last point first, yeah, I agree that I think it would, getting the money to people more easily would be very helpful in that respect. And to go back to your first point, I agree with you, and I think that's one of the reasons why preparers have you know, a reason for being, is that they've you know, that's part of their marketing strategy, is to say we can find you credits that you don't know you're eligible for, and so on and so forth. And so I'm not exactly sure how, now that I have the data, that's a question that I could look at, is sort of what's the trade-off in that respect. In terms of whether or not the benefit is more than the detriment, I have found in other work, and I should say that the paper currently is still in progress and should be out in about October, but I do have a paper on the Census Bureau working paper website for my division that uses aggregate data. So this is the micro data. The aggregate data was given to me before its public use. And in a paper, I find that the people who do receive these products in the long term are actually not as well off. So, and that's the big question with payday lending or any other type of short-term lending, is this consumption smoothing, does it help people? Do they pay off more pressing bills faster? And does it make households better off in the long term? And that research is mixed and more needs to be done, but in my specific case, I found that that was not the case, that households were in the long term worse off. So, you know, but a cost benefit analysis would be useful, and I think that that's a good idea.
We have time for one more question. If anyone has any? We do have one right up here.
This question's for Stacy, and I want to thank everyone for their presentations because I think it's been phenomenal. And I know recently there's certainly been a lot of interest in kind of more of these behavioral nudges and how we can help people more efficiently be more compliant. And so I really appreciate your presentation today. And I wanted to ask if there's any follow-on research that you're planning in this, or any additional tests given your insights here, or anything coming out of like the IRS's Behavioral Insights Toolkit or other research.
Yeah, I think that this can be applied certainly beyond just the two populations we were looking at today. And when you look at the service in general, where we're going and what resources we have to work, say non-filers in particular, this could be applied more general. And I think when we start thinking of some more opportunities for testing it, looking more into the postcard and the letter, for sure. And encouraging that voluntarily filing behavior is going to be more important than ever. So, thank you.
Okay, just on time. Well, thank you to all of our wonderful speakers, and our next session will begin in 5 minutes. So thank you.